just can't do it. I can't take this shit no more, man.
In the fast-paced world of Forex trading, your success often hinges on two critical decisions: when to enter a trade and when to exit. These choices determine your profitability, risk exposure, and overall trading performance. In this article, we will explore the essentials of Forex entry and exit strategies, breaking down actionable insights to help you optimize your trades. Whether you're a beginner or an experienced trader, understanding these principles is key to navigating the Forex market effectively. So be sure to watch the video until the end as I demonstrate and show you the best place to enter a trade in any given market, plus the optimal area to put your take profits and stop loss. Based on my observation and research, this method is barely explained, if explained at all, most if not all Forex gurus and courses that I was able to watch and read. This is mostly due to the fact that it contradicts one of the key components that is taught to be needed to become a successful trader. Can you guess what that is? Stick around to find out. Before diving into specific strategies, it's crucial to grasp why entry and exit points matter. Entering at the wrong time can expose you to unnecessary risk, while poorly timed exits can erode profits or magnify losses. Well-planned entry and exit points allow you to capitalize on price movements effectively. Having defined criteria for entries and exits fosters discipline and reduces emotional decision-making. Use chart patterns, candlestick formations, and technical indicators like moving averages and RSI to identify potential entry points. Example: entering a trade when the price breaks above a resistance level with high trading volume. Keep an eye on economic indicators, news events, and central bank policies that can impact currency pairs. Example: buying a currency when a country's interest rates are expected to rise. Identify key support and resistance levels where the price is likely to bounce or reverse. Example: buying near a strong support level in an uptrend. Confirm the prevailing trend using tools like trend lines, MACD, or the ADX indicator before entering. Example: joining a bullish trend after a pullback to a trend line.
Look at this. Oh, perfect. Oh my God.
Isn't it great?
Chris!
I know, it's my dream.
I have goosebumps everywhere.
Use tools like Fibonacci extensions or previous price highs lows to set realistic profit targets. Example: exiting a long position when the price reaches the 1.618 Fibonacci extension level. Define your maximum acceptable loss by placing stop-loss orders at logical levels. Example: setting a stop-loss just below a recent swing low to protect against downside risk. Use trailing stops to lock in profits as the trade moves in your favor. Example: adjusting your stop-loss upward in a long position as the price rise. Close trades based on a predetermined time frame, especially in shorter-term strategies. Example: exiting a day trade before the market closed to avoid overnight risk. To maximize efficiency, pair your entry and exit strategies. Aim for a risk-to-reward ratio of at least 1.2 to ensure potential rewards outweigh risks. Example: risking 50 pips to gain 100 pips. But try not to make the ratio too big, as this could be counterproductive. Plan for multiple scenarios, including your primary target, partial exits, and worst-case stop-loss. Example: taking partial profits at the first target and letting the rest run. Test your strategies on historical data to identify strengths and weaknesses. Example: refining your entry signals using past chart patterns. Chasing trades. Avoid entering late after a significant price move. Over-leveraging. High leverage magnifies risk and can lead to significant losses. Or ignoring market conditions. Adapt your strategies to trending, ranging, or volatile markets. Emotional decisions. Stick to your plan and avoid impulsive exits. Now for the moment you've been waiting for. Allow me to illustrate how to determine the best places to put your exit level so you can avoid the fluctuation of market prices. Assuming that you have already done your technical analysis, what you should look for is the previous swing highs and lows in a trending market. whether it be an uptrend or a downtrend. For the entry, you can either enter the trade at the close of the candle that broke a structure, or you can wait for the retest of that structure. The latter is the safer and more recommended option of the two. This is to avoid false breakout, which can lead to losing trades. But of course, this is the part that you'll hear many Forex gurus talk about, but what they don't tell you is the exit. The optimal place for a stop loss and/or take profit is also the previous swing highs and lows of the market. In a downtrend, after a retracement, you execute the trade given that your entry conditions are met. Your stop loss is best placed at the previous swing high as you see here. This will ensure that your stop loss is not too small, so you give your trade breathing room if any drawdown were to occur. Your stop loss is not too big. There is no point in having an excessively large stop loss. It just needs to be big enough to give your trades time to recover without stopping you out of the market. Avoid stop hunt. Oftentimes, you'll enter a trade only to see the market touch your stop loss and then head in your direction. We call this stop hunt. If the market remains above the swing low, it's an indication that the market is still in an uptrend. Thus, breaking the swing low means it's the start of a new trend and the end of the previous. Placing your stop loss at the previously swing low means that as long as you're not stopped out, the market is still in an uptrend. Now, the most outstanding thing about this strategy that makes it questionable is the fact that you will notice that a lot of times, your stop loss will be bigger than your take profit. This goes against the traditional risk management that is preached to be needed to be a profitable trader. Because of that, a lot of traders shy away from this method and often do not talk about it. However, with Forex trading, there is no set of predefined rules that must be followed. In fact, approaching the Forex market with a universal approach will inevitably lead to failure. Think of it this way. Forex trading is a war between retail traders and market movers, such as banks and other financial institutions. If the institutions know that most traders are going to trade in a specific way, such as placing their stop loss right below the support level that was retested, which is a common practice for new traders, only for them to learn the hard way not to. It's only logical to think that institutions will push prices down to force traders out of their trades by hitting their stop loss, aka stop hunt. To be more precise, they can see where the liquidity is in the market, which is usually a cluster of stop loss. And if this is hard to comprehend, let's put this in another perspective. It's a known fact that institutions have many advantages over that of retail traders. Among those are the fact that institutions can see your stop loss.
I beg your pardon?
So with that advantage in mind, put yourself in the seat of those banks. Theoretically speaking, since you're able to see the clutter of stop losses, you would then sell, causing the price to fall. This is another advantage institutions have over retail traders. They have large capital that can affect the general direction of the market. Now for new traders, after noticing what the market is going to do, and thinking that this is the start of a new trend, they'll quickly opt into selling the market, especially in the hope of recovering the money that they just lost. The institutions are well aware of this mindset and are very careful not to push prices too far down. Because in the event that they do, the other institutions from around the world would also start selling, which then ultimately changes the direction. As such, they only push prices down without breaking the previous swing low. Now, quick question. For the new traders who think that the market is going down, what do you think they did? You guessed it, they entered a sell position, only for the market to reverse and continue the uptrend. And of course, all those positions are going to be stopped out again. This is one of the most effective ways in which the institutions manipulate the markets to make them and keep the majority of traders frustrated. But once you figure out how the game is played, you can avoid falling into their trap. Mastering Forex entry and exit strategies is a journey that requires practice, patience, and continuous learning. By combining technical and fundamental analysis, leveraging tools like stop loss and trailing stops, and maintaining a disciplined approach, you can improve your trading outcomes significantly. Remember, consistency is key. Develop a plan, stick to it, and refine it over time to align with your trading goals. For a deeper dive into these strategies, watch our full video where we break down real-world examples and offer pro tips to elevate your trading game. If you found this video helpful and want to learn more about mastering the Forex market, be sure to hit that subscribe button to join our community of aspiring traders. We release lots of valuable content like this, so don't miss out on any of it. Thank you for watching.